Hey everyone, it's Lawrence Mack here, real estate broker out of Mississauga, and I'm here with two amazing guys, Chris Mulder from Trideck Mortgage and Ka Dang from Dang and Associates. Hey guys.
Uh, hey, Lawrence.
Hey, Lawrence.
Nice. Thank you very much for joining me. Today we're going to have a panel here to talk about investing for professionals. I get that question a lot from different professionals and clients who are always looking to invest. And I thought, instead of keep referring people over to Chris about the mortgage and keep referring to people to Ka about whether you want to put into a corporation. First of all, just wanted to introduce myself. So my name is Lawrence Mack. I'm a real estate broker out of Mississauga and I service the Toronto area. Ka, can you please quickly introduce yourself?
Sure. My name is Ka Dang, and I'm a CPA CA here. My practice is located in Mississauga, and we specialize in servicing, providing accounting, tax, and assurance services to owner-managed businesses.
Awesome. And Chris?
My name is Chris Mulder. I'm a second generation mortgage broker based out of Toronto on the Danforth. And I also am the president of a private mortgage investment corporation. And it's a family business that we're very proud of running for the last 45 years on the Danforth.
That's awesome. I have a lot of family and friends and clients that all work with both of them. So you're in good hands if you choose either of them. So just a quick idea about who this webinar is ideal for. So typically speaking, we're going to be, talking if you're a professional family who makes more than $150,000 per year, and you want real estate as part of your long-term portfolio, either for diversification or to make money in the long term. And the main reason for that is because tax mitigation is part of the equation, and we're going to talk about that later on about everything. In general, there's a lot of detail in each of these individual topics. So although we are going to briefly gloss over the different topics, if you need specific help, you really should contact the professional and talk in more detail about your specific situation. So these are the four things we're going to be talking about today. The questions are going to be whether you should even invest at all. We're going to talk about investing in residential resale. We're going to talk about investing in pre-construction. And lastly, we're going to talk about whether or not you want to invest with a corporation. So the first question is whether you should invest at all. And the main reason why I bring this up is because there's a few other considerations. It's not just about looking for real estate and then just investing in it. There's a lot of other considerations you have to think about, and a lot of them has to do with tax. So I want to pass this off to Ka, if you can quickly give us an understanding about the principal residence tax exemption in Canada.
Yeah, sure. So if if you live in your own home, and when you sell that home, the capital gains on the your principal residence is there's no tax on that. So there's an exemption that allows for the family or the owners to qualify for a capital gains exemption.
Great. So basically speaking, normally you have to pay tax on like everything. But if you own your own home and you live in it, then you don't have to pay tax on it. So very quickly, the things I want to talk about here is that a few people have came up to me and wanted to look at investment property, but they're actually renting their existing home. And my first suggestion would be maybe it makes sense to buy your own home instead of trying to buy an investment property while renting a home. So for tax purposes, that might be a better idea. And secondly, in terms of upgrading, this is another thing that, from my personal philosophy, I do feel that it makes sense to upgrade your home instead of thinking about another investment home first. That's because, again, depending on your tax bracket, the principal residence tax exemption is very good in that, you save on the taxes. So you might as well have a bigger home that appreciates faster and tax-free in a nicer location so that your family can enjoy it. So that's quickly about whether you should invest at all. And now let's talk about when you actually want to invest. So let's talk about investing in residential resale. First of all, what is residential resale? So residential resale is really buying over somebody else's home. So in general, it would be like buying over somebody's condo and then renting it out. That's the typical process that somebody does. So if that was the case that we're doing it, let's pass it off to Chris. What are you looking for in terms of to qualify for a mortgage that may or may not be different from qualifying for your regular house?
Yeah. So when in any credit application, A mortgage, there are really four cornerstones of any mortgage application, and that is the income of the borrowers, the liabilities of the borrowers, where the down payment money is coming from, and then the fourth cornerstone is the property itself. Is it a residential home? Is it a condo? Do we have to consider condo fees? And the whole purpose of a mortgage application is to determine the ability of a borrower to cash flow a property or carry a mortgage debt, that they have sufficient income to carry mortgage debt. In general, I'm going to generalize here and say that based on current interest rates, a borrower will qualify for roughly 4.75 to 5 times their household income. So to translate that into more practical terms, per $100,000 of income, a borrower can qualify for somewhere between $475,000 to $500,000 of mortgage debt. When it comes to applying for a mortgage on a rental property, one thing to be aware of is that you are required to buy with at least 20% down payment. That's one requirement, as opposed to if you're buying a home for yourself for personal use, provided that the purchase price is under $1 million, you can buy with as little as 5% down. So 20% down. And then in addition to that, the obvious question is, how does the rental income factor into the application? And this, we won't have enough time to go through all the different scenarios, but in general, lenders will credit anywhere between 50% of the rental income to 80% of the rental income. They'll add that to your income on the mortgage application to help you qualify.
Awesome. So that's how the rental income and qualification for mortgage occurs. And then next question is more about capital gains and like how tax is treated there. So I would like Kai just to give your opinion about that.
Okay, sure. If you're buying a rental property, obviously when you sell the property, it results in a capital gains, and there is taxation on the capital gains. So there is, if you qualify for the capital gains exemption, it's not a total capital gains exemption; it's a 50% capital gains exemption. So the inclusion rate is 50%. So 50% of the capital gains gets added to your income in the year you sell the property. Okay. And if if both partners or both spouses own the property, then you split it between the two spouses.
And then what about rental income? How does that factor into a people who have an investment property?
Yeah, so rental income, so the net rental income, so it'd be the gross rental income from the property minus all the related expenses, resulting in the net rental income. So the net rental income then gets added to the total income of the owners at the end of the year as well, right? And again, if both spouses own properties, it gets split, to the two spouses, right? And then taxes added. And then the results and the tax is calculated based upon the total income of the owners.
Okay, so these are things that everyone has to, I guess, take into consideration when they're thinking about doing an investment property, which is how the tax implications of owning a property and what to do during those years. So next, let's talk about investing in pre-construction. So what is pre-construction? First of all, pre-construction, just to give you an idea, is when you see the condos that are being built, and then you put in a deposit today, and then maybe 3 to 4 years from now, it gets built. So that's what we mean by pre-construction or pre-con. And there's a lot of different qualifications and different things that you have to think about for those type of investments. So let's just start off with Chris. So how do you qualify for a mortgage for pre-construction?
Yeah. So the thing about pre-construction is that it has a very long timeline, very long time horizon, because when you go into a sales center, it's just a drawing, it's just a plan. The actual construction can take many years, 3, 4, 5 years is not unusual. And the critical thing is to understand that the mortgage is not required until the building is registered. which is different than the building being complete, because there's something called occupancy, which is when your specific unit is done, you will pay occupancy fees. And then once the condo corporation is formed is when you can actually register a mortgage on it. So you have a very long time horizon. But one of the important things that you should be prepared for in pre-construction is providing a pre-approval. The builder will be very interested in determining that all of their purchasers can qualify for a mortgage. So in order to make a pre-construction purchase, you need to talk to your bank or a mortgage broker to ensure that you can get the required pre-approval to satisfy the builder.
And then typically is that in the form just like of a letter from you, and then we go in and we go buy the pre-construction?
Correct. Yeah, every builder is a little bit different. Some are happy with a generic letter from a mortgage broker or bank, and others will actually have a short list of specific lenders and specific information that is required on that pre-approval letter. So it really depends on a case-by-case basis.
And so since mortgage isn't actually due, does that mean in theory I could put a deposit on many, many different condos and not have to pay for them yet until like 5 years from now?
Yeah, I mean, it goes against the spirit of the pre-approval, of course, because you should technically disclose every time. But in theory, it is possible to do that. And I mean, if you are concerned about the pre-approval and getting the financing, there are many investors that participate in pre-construction that buy the paper, buy the contract, and then assign it before the building is actually built. And of course, over 2-3 years, the value may increase. And so you can sell it for a higher price via assignment, provided you're allowed to from the builder. And that way you don't actually have to close on it and don't require your mortgage. So in theory, you are correct, Lawrence.
Okay, you're just curious. We'll talk about assignments later. So that's the qualification for the mortgage. And then how's capital gains treated if you just put in money for, a deposit right now, and 5 years from now I own the place and then I sell it?
Yeah, if you could believe it, it's actually quite a complicated topic for tax. The reason why is because you're not actually selling a property because you actually haven't closed on the property yet. So this is where, it's probably worth another discussion at some other point. But in general, I just want to point out that you're actually selling a contract and not an actual property. So there are definitely capital gains implications for that. Maybe the treatment could be considered capital gains, or the treatment can also be considered as business income. And also there could also be HST implications along with this contract as well, because you're not actually selling a property, you're actually selling a contract.
Right. So just to reiterate what it is. So we're talking here about assignments. So there's two different parts with pre-construction. So first of all, you put in the deposit, and then afterwards you're just waiting for it to be built like 4 years later kind of thing. But in between now and when it's being built, you can actually sell the contract to someone else who will just take over your contract. And that thing is called an assignment. So there's two different things that we're talking about here. One is like assignment in that you're selling the contract to somebody else. And the other thing is actually closing on the condo and then maybe renting it out and whatever. So I guess, could you talk about the, tax implications if somebody closed on the property fully, and then now I guess, everyone says something about like a 1-year wait period of renting it out before they sell it so that they could do it for capital gains. What are your thoughts on that?
So, from our practice, there, from the law's perspective, there is no there is no specific requirements that you have to hold it for a year or 2 years or 3 years, right? But there is definitely a holding period test. From our practice, we'd like to see people holding it for a couple of years, because it's, if you want to get the capital gains exemption, then you're supposed to be investing in the property, right? You're not supposed to be flipping on the property. It kind of goes against the spirit of the law when it comes to capital gains. You're getting the 50% inclusion rate is supposed to be applicable to your investments, right? But if you're buying property after property and just holding it for a short period of time or no period of time, and you're flipping it, then it seems more like instead of in an investment, you're really doing business and selling it, and then so it results in definitely different tax treatment to these transactions.
Yeah, so to quickly go through the capital gains, an example that someone told me before was that if you were selling Christmas trees versus apple trees, right? So Christmas trees, you just grow a Christmas tree, you sell the tree, and that would just be taxable normally. But an apple tree, you're actually selling the apples as part of your business, and then later on you're selling the apple tree, and then that would be okay for capital gains. Is that roughly how it works?
Yeah, so it would be definitely that's not a bad analogy for sure.
Well, thanks. Heard it from somebody. So anyway, yeah, so there's definitely a lot of different issues with pre-construction, especially if you're going to be assigning it with the tax treatment, especially with HST and with all the different ways they're treated. So definitely you want to talk with Ka about that. And lastly, we want to talk about, we're talking about investing with a corporation. So this is another can of worms that I'm sure we could spend hours and hours on. But let's just quickly, Ka, why would somebody want to buy property with a corporation versus by themselves?
So we get this question all the time. So obviously with accountants and lawyers, right, you're gonna get to, it depends, it's very case specific, but just to generalize, where we see our clients investing in corporations is when the family income is quite high, when they're at the top tax bracket, and so it makes more sense to so it doesn't really have a big impact when it goes inside a corporation. So when investments goes inside a corporation, the rental income does get taxed at the highest tax bracket. So there is really no tax advantages to investing in a corporation, but there are other factors to consider, for one of them being for estate planning reasons, putting it inside a holding company, and that would be a good way to plan for estate transitions in the future.
Right. So maybe setting it up as some type of holding company or just buying it directly or whatever. Either way, you should be talking with Ka about the best way of setting that up. And in terms of the mortgage, how exactly does qualification for mortgage happen in terms of corporation versus personally?
Yeah, it's a very niche area. Not every mortgage lender is actually comfortable lending to a corporation. So you really have to discuss with your bank or a mortgage broker to navigate your way around to figure out what the best mortgage solution is going to be. What I can tell you though is that while the corporation is named on title for the benefits that Ka explained, the corporation in this case, if it's a holding co, doesn't have any income. So the lender is not lending necessarily based on the strength of a corporation that was formed just to hold real estate. They're still lending based on the strength of the borrowers. And so the application for any mortgage that involves a corporation is still focused entirely on the personal covenants of the guarantors, of the owners of that corporation. So anybody who owns that corporation also has to go on mortgage and provide their personal covenant as well. So they're not necessarily on title, which has tax implications that Ka is talking about, but certainly they still have to qualify for that mortgage based on their personal income and liabilities.
Great. Well, that basically covers everything I wanted to cover today. Thank you very much for answering those. Does anyone have anything else to add about either four of those? Chris, in general?
No, I think obviously in a city like Toronto, where real estate has performed so well, it's very popular to pursue investment opportunities in real estate, and they're exciting opportunities. But we've also seen, and Ka and Lawrence, I'm sure you have personal experiences as well of people who get into trouble. So you do need some good guidance around you and a good team around you, and just make sure you're getting professional advice, whether it's from us or anybody else in your circle. Do seek the guidance of professionals.
Excellent. Sounds great. And Ka, anything else to add?
I was just gonna say, in our practice right now, we're seeing a lot of, definitely a lot of assignments. So I just want to, let the everybody know just to be careful. Please definitely be careful with those assignments. They are tricky, and so definitely do try and seek help with those. If you're definitely planning on selling the assignment contracts, please do seek professional help, definitely from the broker and from the accountants as well.
Excellent advice. I've heard some very bad advice floating around in terms of, oh yeah, you just, get the assignment and flip it and you don't have to declare it as income or whatever. And, things like that. It's like, just make sure you have the right advice from the right professionals, just so you don't get any trouble down the road. Anyway, thank you very much for joining me, gentlemen. So just as a wrap up, my name is Lawrence Mack. I'm a real estate broker out of Mississauga, and I service real estate around the GTA. And Chris?
I am, Chris Mulder, mortgage broker off the Danforth. I believe here on the screen, you have my phone number. You can also Google me. I'm very transparent, very easy to find, and look forward to talking to you.
Excellent. And Ka?
Thanks, Lawrence, for inviting me to the panel. I really appreciate it. Again, my name is Kyle Dang. I'm from Dang Associates CPA. And if you have any questions regarding taxes for investments in real estate, please give me a shout, and I'd be happy to answer any questions you have.
Sounds perfect. Thank you very much. Bye, everyone.